Hi, I'm Scott Marshall. I'm the founder and managing director of Roma Finance. Today I'm going to talk a little bit about the economy, where we are, how we got here, and where we expect things to go both for the UK economy, for the property market, and where we see that there are opportunities not only for this year but looking further into the future, into 2025 and beyond. So if we first of all take the history of how we got to where we got to, and if we think back just 2.5 years, in October 2021, base rate was 0.1%. And if we think back even further, 3 years ago, where base rate was still 0.1%, the talk at that time, 3 years ago, was that base rate was going to go negative, and the likelihood and the impact of what negative interest rates might do to the economy. Well, the reality was that we were in a very unprecedented times 3 years ago. In April 2021, we were still very much in the middle of COVID. There were situations where China was closed. People remember the ship that got stuck in the Suez Canal. And these two factors meant that there was a material shortage in supply. And with the government having given money under the furlough scheme and the property market having received boosts from the stamp duty holiday and from the Help to Buy scheme, those things together meant that demand materially outstripped supply. And these factors meant that actually the reality of negative base rates, negative Bank of England base rates, was never going to happen. And we saw quite quickly, even before the start of the Ukraine-Russia war, that there were already material inflationary pressures that started to become evident in September and October 2021. And so by the time we got to the first base rate increase in December 2021, we could already see that there were calls that the Bank of England had become too slow to raise base rates in order to take the heat out of the economy. And what we saw over a period of 18 months was that every 6 weeks virtually, where the Bank of England met, the Monetary Policy Committee met, there was a further and quite a hard and fast increase in the Bank of England base rate, to the point where in August 2023, the Bank of England base rate was increased to where it is now, 8 months later, at 5.25%. That's over a 5,000% increase in base rates, 50 times where they were 18 months previously. And there were calls of the Bank of England to stop raising interest rates because of the damage that it might do to the economy. Now, if we think about where we were in a cost of living crisis at that time, where people's monthly disposable income was going down because of the fact that everything was costing more, it didn't make sense that the Bank of England was actually raising interest rates to take more money out of people's pockets at a time when they could least afford it. So why was the Bank of England raising interest rates, and why was it doing it so quickly in order to take heat out of the economy when actually natural price increases due to supply side constraints was having that impact and effect anyway? So there are a number of factors and a number of reasons why it did that. Reason number one was because if we think back to where we were, there was a material shortage of labour in the market, and that meant that people, normal workers, employees, staff, were seeking pay rises. And because of the increases in salaries, both for people that were employed, for people looking for work, and also in the public sector, the Bank of England had to take that heat out of the economy so that people felt less secure in their jobs, so that merry-go-round of people wanting higher wages to pay for a cost of living crisis in order to meet their monthly bills, because there was a shortage in in people to fill those jobs, and therefore people were able to demand higher salaries. That is one of the reasons why the Bank of England was raising interest rates, so that people felt less secure in their jobs and were no longer interested to ask for pay rises because of the insecurity in their jobs that they felt. So that's one reason. Second reason, there are a multitude of reasons, but the second reason that often is not reported in the media is actually that we are effectively a slave to what goes on in the States. So if we take America, for example, the Fed raised interest rates almost hand in glove with what was going on with the Bank of England, to the point where the Fed interest rate is now between 5.25% and 5.5%, which ties in very well with where the Bank of England base rate is now. The reason why we are a slave to what goes on in the States is because almost all commodities around the world and almost all imports and exports around the world are traded in dollars. And if we don't increase interest rates in line with what the Fed does, then money comes out of the UK economy and goes into the US, where interest rates were obviously higher. So what the Bank of England can't do is to see money coming out of the UK economy going into a different country because they're paying a higher return. Because what that does is it destabilises and weakens the pound, and a weaker pound means that imports cost more, and we are, by nature, we're an importing economy. And so if the pound weakens and the dollar strengthens, actually that in itself is inflationary, because the imports therefore cost more. So the Bank of England has no choice but to match what is going on, roughly speaking, with what is going on over in the States with the Federal Reserve. And where we are now, today, in April 2024, is that the US economy is performing strongly. Their unemployment rate, so levels of jobs, is still strong. And in the UK, if we consider where jobs are in the UK, everyone was expecting that unemployment would increase in the UK. But if we actually look at the statistics, pre-COVID, there were 27 million people in work in the UK. And now, in April 2024, the latest figures that we've got, there are almost 33 million people in jobs in the UK. So employment has actually increased. And if we look at employment over the last quarter, between December 2023 and February 2024, actually employment, there's 1.8% more people in jobs in February 2024 than they were in November 2023. So the jobs market is still performing very strongly. And so because there's no pressure on the Fed to reduce interest rates, because the American economy is doing well, and because employment, or the unemployment figures are not increasing in the UK, there's no real pressure at the moment on the Bank of England to reduce base rates in the UK. So whilst people are expecting and are talking at the moment about a rate reduction in June of this year, at this moment in time, until we see that unemployment is going up in the UK and the inflationary pressures, particularly in the services sector and in banking and finance, are coming down, then there's no reason for the Bank of England to reduce the base rate. So that's where we got to now, and that's a kind of a prediction for the next 3 months. I think ultimately a high base rate, and by the way, base rates are high compared to where they were 2.5 years ago, but they're not really high compared to where they have been historically pre-credit crunch. And the level of 5-ish% actually is a relative average for base rates. So we are currently trading in a normal base rate environment rather than a high base rate environment. And people, who have got fairly short memories will think to themselves, well, actually, base rate's been low for a very long time. But the reality is that pre-2008, base rates have averaged around 5%. And if I think back to when I bought my first property in 1997, I think that the first mortgage that I got was at 5.99 fixed, and I thought that was a good deal at the time. So I think we have to get used to base rates being where they are and around this level for some considerable time. So, in terms of the property market, well, everybody has been expecting that the property market would deteriorate whilst interest rates have been going up. And it's certainly been true that demand for property and property transactions have fallen away during this time, but property prices haven't been reducing. And there are a number of reasons for that. Reason number one is that if we look at what happened in 2008, the banks were materially undercapitalised. And the banks being undercapitalised meant that when customers could not afford the loans that they had, the banks had no choice but to go and repossess because they themselves had a cash call because they were undercapitalised. On top of that, if we look at the way that banks looked at affordability, and it was largely unregulated in the way that affordability was looked at. A lot of people had not been declared. Well, the subprime market crash. People know what happened there, where people were declaring income that they never were receiving, overinflating property prices, overinflating their income, and so that came crashing down quite quickly, together with the undercapitalisation of the banks and the lenders. Fast forward to where we are today, the banks have got material capital reserves thanks to the pressures to regulate them in a much stronger way from the PRA and the FCA. So banks can weather the storm because they've got much better capital bases. The second thing is the way in which affordability has been tested. The way affordability, people have been asked to prove their affordability. So the banks have been stress testing people's payments materially above the mortgage rates that they've been paying, so they can be so the borrowers can be more resilient. The third thing is that weighted average loan to values across lenders' mortgage books actually is around 40%. So if we see the kind of tools that the banks and lenders have available to them, what they can often do is to capitalise people's arrears if they are struggling to pay into a longer mortgage, and because they've not needed the capital themselves, they've been able to offer customers different solutions where they've struggled with payments. And so we've not seen a material increase in repossessions cases. One other thing is because affordability has been so much better, people have been able to, there's not been the kind of arrears that we thought that there would be. And therefore, the property market, together with one other factor, which is there's still a material shortage of property for too many people. So there's still an undersupply for a greater demand. So only sellers that are in a distressed state have needed to sell. And actually those distressed sellers, the banks have often been able to work out a way to help those people so they don't need to sell in a distressed way. We've seen a smaller correction in the property market and a far greater resilience in the property market than people were expecting. So we're not seeing a property crash. I think we're unlikely to see a property crash. And not only that, but with wages having increased over the past 12 to 18 months as the cost of living crisis and the shortage of labour that we talked about earlier, as that's kind of helped people's affordability. So there's been no material pressures on the property market. Now, our industry depends on a liquid property market and a liquid mortgage market. Because lenders have been far better capitalised than they were before, and there's a lot of capital still washing around the system, that has meant that the property market, although transactions have slowed, actually prices have been sustained. They've not been going up in the way that they were when base rate was lower, or where during COVID, where people were looking for a different type of investment, or the stamp duty holiday, actually prices have been sustained. So the only part of the market where that's been struggling has been the buy-to-let space, where the tax changes that were introduced at the end of the last decade and have obviously taken hold now. The buy-to-let space, there have been a reduction in landlords, people looking to offload buy-to-let property, single-unit buy-to-lets. And what that's meant is that there's been a shortage in buy-to-let properties, which has driven rents up. And that, together with rising costs for the landlords who want to hold on to those properties, has meant that actually landlords have been, in some ways, able to maintain margin because they've been able to demand a higher rent from their existing borrowers. And when properties have come back onto the market, they've been able to ask for a higher rent for those properties because the demand has been there. We've seen in some areas, there's been 20 times the number of people looking for a property as has been actually on the market, which has driven rents up. So, interestingly, there's been quite a sort of government attack on the smaller landlord properties that have been held in individual units, in individual people's names. And I think that whilst this is likely to continue, those landlords that are professional, whether they're the smaller landlords or the bigger landlords, the professional landlords, they've been able to weather the storm. And I think what we've seen is, and will continue to see, is a professionalisation of that sector, and landlords looking for higher yielding properties such as HMOs and multi-unit freehold blocks where a single tenant void does not result in a borrower's inability to pay their mortgage. And those higher yielding properties, certainly in areas where there's liquid, the areas where there's a high demand for rental properties, in urban areas, near schools, near hospitals, near universities, near kind of sort of urban infrastructure, will continue to see rents being sustained, and landlords looking to invest in those areas. So where do we think that there may be some challenges for property investors and property developers going forwards? Well, if we think about the political changes that may well happen over the next 12 months, we are likely, not definitely, but we're likely to see a change in government. And we've already seen that Labour have dipped their toe in the water as to maybe how the green belts can be restructured. Well, what's around the green belt is often higher value properties, and if green belt areas are used, and we already know that there is a shortage of social housing, there's a shortage of affordable property, and those houses that are on the edges of greenbelt tend to be higher value properties, and often those people that live in those areas are more likely to be Tory voters. So a Labour government may come in and may say, right, okay, we've dipped our toe in the water over the green belts already. There's not been the kind of public backlash that we were necessarily expecting, which is why we dipped our toe in the water. So let's go and try to sort out the planning system, and let's put affordable housing and a new type of social housing or a new type of council estate in greenbelt areas. And that will level up prices in greenbelt areas. So if I was a property investor, property developer now, I'd be thinking to myself, well, if there's an opportunity to develop properties on the edges in nice areas of where there's greenbelt now, I might be saying to myself, well, actually there may be some volatility in the values of those properties in the short term. I need to think about somewhere else to go and put my money into, invest and to develop. Where else should we invest? Well, one of those areas, and we're seeing lots of urban areas be regenerated, is around town centres and city centres. Why? Because we've seen the high street and the impact that online shopping, for example, and other things have had on the high street. So the high street has been struggling. There's not been as much footfall in city centres in urban areas, partly as a result of COVID, and that's kind of forced us to change the way in which we shop. But also, I think generally speaking, online retailers have taken a bigger share of the market, and commodity items where you can go and buy online, people have been doing so because it's far more convenient. So that, together with home working, because lots of people have been having a more flexible way of working, has meant that office space has become redundant, less used, I should say, in urban areas. That, together with the kind of decimation of the high street, has meant that those areas, capital values have dropped and are dropping. There's been, and we can already see in certain areas that, like Manchester and areas in the northwest, there's been an investment in those local areas by local authorities in order to get those properties and repurpose those properties. So increasing amount of vacant office space together with capital values having fallen for the high street, together with some of the planning changes around PDR and the way in which properties can be repurposed, together with local authorities and their investment in those urban areas, has meant that actually they potentially are fantastic investments for property investors and property developers, because they can buy those properties cheap. The investment now that local authorities are making in those areas means that as they want to attract more people to live in city centres, in town centres, increasing amount of footfall that will result in 1, 2, 3 years' time will attract those retailers back into those areas, coffee shops, restaurants, leisure premises, etc., to see capital values and demand increase. So I think that from a developer's space right now, investing in areas where local authorities are investing in the regeneration of town centres and city centres represents a fantastic opportunity, and one that developers and investors should be thinking about. Whereas investing in greenbelt areas, in higher value properties, with what we can see coming down the track politically, I think actually is more risky. And what we say to our customers is always think about where you're putting your money, where you're developing property, and the projects that you should be investing in are where there is a liquid property market and big demand for the products that you are creating. And where is the biggest demand? The biggest demand is going to be where other people want to live and where invest and when other people are investing. So buy cheap, renovate at a good price, and then where we see local authorities investing, so there's likely to be capital appreciation of those properties.